Today, this is the only section we focus on the growth stage. So growth stage is the most important thing. Why? Because we are doing a Go Global event, which means you should go global. So how do you go to global? You cannot go it by yourself. Everybody needs to raise money to go global. But what is the problem? We don't have enough growth funds in Turkey. So that's why we have this great, our guests coming from Europe and UK. So one of the funds is from US, other one from UK, another one from Europe actually. So global fund, focus on the Middle East, North Africa, everywhere, and the Europe fund. So who is Ihsan? I'm the Ihsan who is running the Finberg and who launched the Finberg in 2018. Finberg is the FIBA Group corporate venture capital investment platform. We have 4 different funds: seed stage, post-seed, early growth, and the funds of funds. Totally, we have invested $120 million. We have invested 17 funds all over the world, and directly 48 companies. I hope they will invest our portfolio companies also. That's why we invite them here. So, first of all, we can start directly with you. Just give us first your fund portfolio, profile, and your mandate, and yourself.
Perfect. Hi. Great to be here. Also proud investor of Trendyol and insider here in Turkey, so know the ecosystem quite well. Excited. General Atlantic is a global growth equity firm. We were founded in the 1980s by an entrepreneur himself, and now 45 years fast forward, we are 100 billion under management, invest 8 to 10 billion every year in fast-growing, innovative technology, financial services, healthcare companies all around the world. We believe in globalization and have offices in LATAM, in Asia, in Europe. So we really believe in strength of getting companies out there, getting companies global. We invest typically from 100 million up to 1 billion and looking for great entrepreneurs that we can build the next growth stage with.
Thank you very much. Udayan?
Thank you, and thanks for having me here today. Great event and second year running coming, so it's really great to be here. So Apis Partners, we're a private equity firm focused on the intersection of financial services and technology. So fintech, 11 years in operation. Third fund, we're on our third fund, which is over $1 billion now. And by way of background, I used to be the global head of financial technology at Deutsche Bank. Prior to that, at Credit Suisse and DLJ till 2009. Then I founded Anthemis Group, which is the largest early-stage fintech investor in Europe, and now started Apis in 2014, which is, I think, now the largest fintech investor again. We're in the as a single vertical where we invest across Africa, South Asia, Southeast Asia, and Europe, and we have offices in London, Singapore, and Dubai. And I think I was talking to Jem earlier, who was on the earlier panel, and I told him we took inspiration from him because if you know Early Bird East, which was his fund, and his fund was actually rated by Dow Jones, HEC, as the best performing venture fund in the world. And Dow Jones has 3 rankings, venture, growth, and buyout. And this year we made the growth rankings for the first time, because you need to have 10 years of data to be there. And we are ranked as the second best performing growth fund in the world, which I think is sort of very helpful and a testament to the team and the markets that we operate in, including this one. So
I said congratulations to him because of this, but also today his birthday. So
I was hoping you wouldn't say that, but yeah.
He's turning to 60.
Yeah.
Now it's a 50 years old guy. So thanks because he came from the Athens, his wife is over there, so he's spending his birthday time with us on the panel. Thank you very much again. Bernard.
Thank you.
Well, first, teşekkür ederim for inviting us, me, as a representative of Truffle Capital. So I am the co-founder of Truffle Capital, and before that I used to work on financial markets as a trader. And then I was an entrepreneur. I had a company in robotics, which I sold, and we founded with my partner. He was in the Silicon Valley in life science. I'm in tech. we co-founded Truffle Capital with the scope of bringing entrepreneurial DNA to the VC environment in Europe. So we are currently investing in two areas, life science on one hand and fintech on the other hand. We've raised, so we are at the very first part of a growth stage. We invest in companies between 5 to 50 million euros in ARR. And we have made 120 investments, 76 exits, and 15 IPOs, of which the last we exited this summer on a company which value increased tenfold in a couple of days. So here in Turkey, we have one investment in DigiPay. We are a board member of the company. We've got accustomed to Turkey about 3 years ago, and that is a very good experience that we have, and we are very much enthusiastic about the country prospects in terms of fintech.
Very good. Actually, Bernard and Christopher has already investments in Turkey. Bernard is the first investment. Christopher's General Atlantic has 3 investments totally as of this story. Udayan now is planning to invest in Turkey, but personally he is an investor in Turkey for a long time ago.
20 years, yeah.
20 years ago. So thanks for investing in Turkey. And also their sitting position is Bernard is investing 5 to 50, Udayan investing 50 to 150, maybe sometimes 200. They are starting to invest 150 to above. There is no limit.
Roughly $1 billion or so.
Billion, okay, it's $1 billion. So let's come to the growth stage environment. So how is the environment right now? How easy to raise money for scale-ups, I'm asking. And what are the new terms and other things happening in this growth stage? I'm talking about what are your main focuses? Not just answer the question like AI or something. I'm not asking that part. I'm asking the whole environment. What type of company is more attractive these days? And actually, that's the point.
Should I start?
Yeah.
Okay. I think with AI, the entire ecosystem is changing, and it also affects other companies in completely different areas. It goes through all kinds of business models. So this is also an aspect that founder teams need to be aware of. Like, how do they position the companies in the world of AI? But there's still so many business models that, as we had it before in the previous panel, the 3-3-2-2, that still manage to grow at that rates, and strong founder teams across the regions. So there's still, in the world of AI, business models that are super resilient, have high quality revenues, high quality teams that scale outside of their geography into other markets that may continue to be of interest for us as a growth investor.
Okay, cool. What do you want to add?
So I think in terms of the environment for growth companies, I think the most important thing is the paradigm has shifted, right? So if you think about where people were putting money in 4 or 5 years ago, we've always been a cash flow investor, right? So we've always wanted to focus on companies that create cash flow. But the concept of not actually being cash flow positive and raising growth capital is becoming more and more difficult, right? So I think that concept of very late stage growth venture style investing is drying up a little bit, and the crossover funds have disappeared as a result of it, right? So I think from an entrepreneur perspective, the focus has got to be to demonstrate not just positive unit economics and product market fit, but actually to make money and actually to show that you have positive cash. We will not invest in companies unless they show positive cash flow generally. So it's pretty hard for us to come in. So that's always been our focus. And I think that's actually permeated not only in the private markets, but actually in the public markets as well, right? There is a real differentiation for those companies that are able to show trajectory to actual proper margins and sustainable margins over time. And we're starting to see that across every industry. And then the final piece, I think, obviously to the point that Christophe was making around the AI game, AI is an enabling technology for everything. And in my industry, which is financial services, it's a very key enabling technology, because financial services by its nature is a digital product. And the minute you have a digital product, AI lends itself extensively to actually creating efficiencies within that digital product. So we see it across the entire portfolio.
Yeah, as a matter of fact, I'm doing some retrospect on what we have assessed right and wrong in the companies since we started investing. So that's 20 years ago now. I would say that we stick to our DNA, which is to be, I would say, B2B, and that the best performing companies in our portfolio are always B2B. And also they can scale, so they can be international, and that's really what we can bring in terms of added value to the companies, is especially in the country here, we can help scale. And one additional factor is when the founders have an entrepreneurial experience, repeat entrepreneurs. They have a resilience in their DNA reinforced by experience. So that's really a factor that is a significant success factor. And last point is what I find very interesting in the market we're in is there's always, every 2 or 3 years, there's a reshuffling of the cards. So it's not like, you're once and for all the market leader forever. And as a matter of fact, AI is reshuffling the cards. So if you don't incorporate that into your business model, then you're dead. But if you do have to compete with everyone else that is doing it.
Yeah. So as a growth fund, actually, I came from the Riyadh to FII. So there were 3-4 main subjects people are discussing. All the panels are the same. The one of them is, of course, secondaries. Other one is the exit. And the third one is the private-public market, how to get together, because private market is getting bigger than the public market. So going to the first topic. So do you prefer the secondaries when you are investing to the companies? What's your approach about secondary? Because I heard that some big growth funds, they don't like secondaries, they don't want to do it, or they don't like the founders doing a secondaries. So I need to be just a little bit open that, because in Turkey these days they are talking too much about the secondaries, okay? It's like a dilemma, because we don't used to that. We almost of the, 80% of our startup ecosystem is the not growth stage. So growth stage is now happening. So these deals like secondaries and other things happening right now in Turkey, so we don't know how that much in Turkey. So that's why I'm asking the question. What's your approach about secondary? Is the good tool to just decrease the valuation at the company, or it's just a tool for make motivation for founders and who owns the stock options in the company, or just try to clean the table? Do you prefer secondaries, or if you prefer, why do you prefer? If you don't like, why don't you like?
It's a very case-by-case situation. We don't exclude secondaries per se, we don't exclude primaries per se. It really depends on what the situation is. You mentioned one example where it helps cleaning the cap table ahead of an IPO, or to simplify the structure where you just can get more efficient with a cleaner cap table, where it completely makes sense. There's also situations where you have a founder who has put in so much effort, time, risk, where taking some secondary can actually help for the next growth phase, that this individual continues taking risk because he has some security on the financial side at home. So there are a lot of positive aspects to secondaries as well, and we don't just typically exclude them.
Okay, clear.
I mean, I absolutely 100% case by case, but you have to look at it in the following context, right? So there are different types of companies, right? A company, if it's a completely bootstrapped company where there are no outside investors by the time you come in and they're cash flow positive, then it is tricky, because we really don't like, unless there's a founder that's leaving, we don't like the founder taking a lot of money off the table, because then it creates a misalignment and the incentives are wrong, right? But if we're cleaning up the cap table, then of course it makes a lot of sense. We like to clean up the cap table, and yeah, we like to average down our cost, because there is a wide discount between primary and secondary in this current market.
What are discounts these days?
I mean, it can be up to 50, 60%, right? I mean, on
50,
average, I think, on average, it's 25 to 40%. I mean, that's how we're doing it right now. And why is there a discount? Because actually liquidity is at premium in this market, right? Because what's happened over the last 10 years in the private markets is There's been a lot of investment and there haven't been a lot of exits, so there's no liquidity. So if you're, especially with family offices, they're struggling with liquidity. Some of the institutional investors are struggling with liquidity. So if you can offer them liquidity, they will take a bigger discount, and it's an opportunity for us to average down. So there's that aspect of it as well. So what you're trying to do is create a balance where you're coming in at the right valuation. You are making sure that there's alignment with the entrepreneurs that are sitting within the institution, and that you're cleaning out the cap table, particularly angel investors, because as you scale these businesses and you go to the ultimate exit, one of the things you want to do is have a reasonably clean cap table, because it makes your life easier when it comes to the exit.
Thank you very much.
And yeah, I would say this is a very financial market, because you do have a discount when you invest in secondary, so your calculations are more financial, less tech. That being said, the current moment in time is, I think, very favorable for secondaries in certain areas, certain industries. So if you take the financial industry, it's been very fashionable among banks, insurance companies, financial institutions to have their own portfolio, CVC, corporate venture capital. That was like 4 or 5 years ago. Then there was a change in global interest rates and the change of focus, and it makes the financial institutions willing to refocus 100% again on their core business. So you see happening on the market a number of disposals, I would say, or outsourcing of CVCs. And at Truffle, we're very much very interested at that. We are about to sign LOI with a financial institution which has developed CVC with about 45 holdings, and they just can't manage that because it's not their business. So we think the next 3 to 4 years are going to be years when the institutions will divest their CVCs, and maybe the cycle will change again in 5 years, because it's a recurring change of cycle. We've seen that since we've created Truffle.
Yeah, it's clear. So I don't want to ask the big questions, okay? I will go to short questions like the secondary. So my next question is about actually the roll-up strategy. Okay, these days I'm hearing that the roll-up playbook is very popular, especially getting ready for the IPO, doing the roll-ups. So if some company asks you for raise money for the roll-up, how do you look at that? You like to do roll-ups in the one country to dominate whole country, or you are looking to some roll-up strategies, do the same thing in the similar countries, making to the one big company? Do you like the roll-up strategy?
We are not opposed to it. I think there has to be an industrial logic behind why it makes sense to combine two companies, and why the sum is not 1 + 1 is 2, but 3. So there has to be some kind of industrial logic. As growth investors, we typically want to see some proof points that it has worked once or twice, and they are now ready to institutionalize it, to expand further. There are models that work more on a domestic scale, and there are models that work internationally, but it also depends on a case-by-case situation. But we like it in general if a founder has proven that they can acquire, that they can handle the integration, that they can scale further and keep the operations efficient. And once they have proven that, and they want to take the next step, take on bigger amount of money to really scale up the roll-up, and then it's something that is interesting to us.
Okay.
I mean, there's no one-size-fits-all strategy here. You have to think about it the following, right? If you're in a roll-up, we invest in India, for example, right? If you're in India, I don't really want them to be rolling up stuff outside of India. India is a country of 1.4 billion people. There's lots of opportunity to create larger market share, and I don't think you necessarily create incremental value by going outside of India because of the nature of that market, right? And also the way India is one of 3 markets in the world where I think there's a great IPO market. Turkey is one of them, India is one of them, and interestingly enough, the third one is Saudi Arabia for structural reasons, right? Anywhere else in the world, I think if you're a subscale company, doing an IPO is a big mistake, right? So in India, if you're doing an IPO, you want to be a domestic company because you get more, you get a better valuation, people look at you differently, and it's easier to go out into the market. Whereas if you're in a small market, actually we encourage you to do cross-border, right? Because we don't really want to invest in small markets because the total market size is too small. But if you can create a regional champion by doing a roll-up, that becomes very interesting. The third thing I'd say about this thing is that as a fund, as a fund manager, we generally tend to do no more than 1 or 2 roll-ups in each fund because they tend to be extremely time-consuming for the team. So we really don't have the time because when we do roll-ups, they are very consuming. We did the biggest payment roll-up in Africa, direct payment online, which we sold to Network International, which is the largest payment company in the Middle East. That was 7 acquisitions over the course of 3 years. We went from 2 million to 20 million. Very advantageous from an economic perspective because we were buying revenues at about 3 times revenues, and we sold 20 million of revenues at 20 times revenues. So you can, and that was a 6x return. So that it is advantageous, but it takes up a lot of time. So it's a little bit of where you fit it in as well.
Yeah, very much. I think it depends also a lot about the management team. First, their appetite, their willingness to conduct an acquisition, their ambition. Do they want to do that? Their ability to take additional risks, because when you build up or when you roll up, you will probably buy a company that's a size similar to your company. So it's like playing poker and playing again what you have won. So it's taking another round of risk. And that being said, in general, as we said, it's a case-by-case basis, but we tend to like to do it, especially as a European investor in Turkish companies. We think that's something we can bring. We can help those companies do that. It won't relieve the managers from the pressure of doing that, but we can help. And actually, we have done that with DigiPay, as you know, conducting the acquisition of NeoPay in Dubai is a $350 million acquisition for a company that was small 2 years ago. That's quite ambitious. That's quite a move. We've done that. We're happy with that. So yes, I would say it's a smart move.
I mean, I've seen DigiPay's example. It's a very great example. That's the bit I didn't say is one of the things that we like for Turkish companies. I think doing the roll-ups outside of Turkey is very important because of the currency diversification, right? Mm-hmm. Being 100% Turkish lira makes it very difficult long-term for investors to come in because of the volatility of the currency. So that's big. And we actually backed, as you know, M&T Haaland, which is the largest non-bank financial services company in Egypt, to buy TAM Factoring here, which allowed it to actually diversify into Turkey. So it can go both ways, right? But I think for Turkish companies looking to scale, having that revenue diversification and having dollarized revenues is also quite interesting.
Yeah, so it's clear that you need a really strong strategic rationality. So coming to the last part, actually, mainly, to the exit. So how is the exit environment right now? Just divided into the IPO market or strategic acquisition? So how do you see market going to happen in 2026, actually? Because people are waiting for a long time to sell their companies because of this cycle. So, of course, these days the prices are very down when you try to sell something. So do you see any hope for the next year increasing the liquidity or public market? If you have any idea about the spec, you can put it inside of your answer. Because, I told you I heard lots of things, specs coming back right now in the U.S. So in Turkey, we have a different product. Nobody thinks like that, but it's like a spec, GSYO. It's a girişim sermayesi yatırım ortaklığı. It's just a spec, actually. So it's a new in Turkey. Now launching 4 or 5 or 6, but in Turkey we do it just for portfolio, 3 or 2 of them at the same time. So the question is exit, IPO, strategic acquisition, and maybe SPAC.
So on the private market and IPO market side, what we see is a huge difference between smaller companies, lower scale, less profitability, lower growth, and the really high quality businesses out there. The high quality businesses, they will always raise money, and they are raising currently at very rich valuations. The other side, they are currently seeing quite a lot of challenges, and this is combined with you mentioned earlier, family offices, funds that are looking for liquidities or accepting huge discounts, so are willing to transact. So we see valuations for the more B businesses really going down at the moment, whereas the high quality businesses, they are transacting at outrageous multiples. And the same goes for the IPO markets. We see them opening up. We see them that the best companies out there are getting good valuations. We see that a number of IPOs are steadily increasing this year. We expect that next year is going to be a big year for IPOs, but you got to be in that top corner, good growth, good metrics, good scale, and really have to create demand with investors. Otherwise, it's going to be a tough environment.
So when you say the IPO, do you just focus on the US or you are looking for the...
No, we're looking globally at IPOs.
All the
we also
markets.
had IPOs in India. You mentioned the 3 locations that are extremely attractive for IPOs right now. So more from a global lens speaking.
Okay, thank you.
Yeah, I would say that the exit market is definitely improving. However, keep in mind, I think the exit markets are basically 6 months, have a 6 months time lag to public markets, right? So I think, I mean, it's a I'm not saying it's a hard, fast rule, but I think in my experience has been that generally that's where exit markets are. So if you have a very strong, resilient public market, which you have right now, your IPO market opens up 6 to 12 months later on, which is what we're seeing right now. Now, the worry, of course, is that we're in correction territory in the United States. I don't know where we're going to go with this market. It's been a very sustained long-term bull market. If we have a massive correction, then who knows where the exit market's going to be. As far as IPO markets are concerned, the US IPO market is very open. There are lots of IPOs happening. But really, that's a large cap market, right? So if you're not going to be a 5 billion plus company, don't bother going to list on the NASDAQ. It's a waste of time, right? Then you've got the 3 markets that I mentioned, which are very interesting, and then you exit. We generally, 90% of our exits are to strategics. We prefer to sell to strategics. We don't like lockups that come with IPOs. We don't like the vol that comes with it. So we generally like to strategics. The only place we cannot do that is India, because Indian public markets are always better than private markets, right? You can always do better on the Indian public markets. It's the nature of that market, because you can't export capital out of India, and so all the capital comes back into the market, right? And it chases IPOs, and that's what's happening.
So for Turkey, you think IPO market is better, right?
I think Turkey has a very strong IPO market, on a relative basis. And the thing with Turkey is that if you are a company with predominantly Turkish lira revenues, it is very hard to get a strategic buyer to buy you, right? Because of that currency. So actually the IPO market becomes, now that will change over time as some of the issues around the currency start to normalize like they did previously, and you'll have a more influx. But until then, obviously there's a preferred route into the IPO market, and you get very, very good valuations into that IPO market. So yeah, and then the final piece, of course, is that the exit market is obviously dependent on your specific subsector and how the health of the large buyers in that market. For example, payments as an area has taken a big hit over the last 3 or 4 weeks. There's been a correction because of what happened to Fiserv. And so now I'm looking at that exit market. It's not looking so good. So you also have to look at sort of the subsectors within that and see what's happening there.
Do you want to add something?
Yeah, let's be pragmatic. We're businessmen, so it's not trade sale against IPO or IPO against trade sale. It's both. Sometimes dual track, and whatever provides a good return for the investors. So, and statistics are always very interesting, but difficult to analyze. I prefer facts. So when I see in our portfolio, I may see a trend, but I'm not sure. It's just a sample. We have about 35 companies in the portfolio between healthcare and fintech. We were lucky enough to have a quoted company in July, which for some reasons had a good result, and the stock price was multiplied by 10. So then we exited everything in about 1 month, like we just finished. So we're opportunistic. And then we also have recently signed a LOI for a trade sale for a company. We are selling at 8 times AR. So it's a good price for a company that has grown rapidly. We paid in cash. So Is it a trend? Does it mean that the market is recovering and we have more and more exits? We expect so, but once again, I prefer facts and cash at the bank and cash for the investors rather than just statistics, because it's difficult to, see where the statistics are leading us.
Sorry, I just answer your SPAC question because we talked about it earlier. SPACs,
Nobody
I
wants to answer it.
completely agree with what Christopher was saying in the break, which is SPACs are a sign of market excess. The minute you see SPACs coming back up, you know that you're definitely getting into bubble territory. We actually, as a firm, had filed to do a SPAC a few years ago, and thank God we pulled it just as the market was getting. So I'm not a very big supporter of SPACs in general. I think companies that de-SPAC generally tend to not ever have a good performance post-SPAC, and I've had a few exits myself into SPACs, and they've been disasters.
Okay, great. So let me summarize in the 5 points, okay, because we are coming to the end of our panel. The first thing is, we are very positive about the growth stage investments. It's going better right now. We are open to invest more, especially international companies. The second thing, in the secondary, you are not against the secondary. It can be useful for the cleaning the cap table, plus for cost structuring, actually, sometimes to use that. But you are not very fan of giving to the entrepreneur lots of money to make him rich before the exit. And the third stage, okay, the roll-up strategy can be a strategy, a good playbook, but there should be a really good strategic reasons to do that, and you should be ready for after the roll-up, how you can manage it. And the exit side, so IPO market looks like getting better. But some of you more focus on the strategic acquisitions better than the IPO market because of the lockups and other things. But as I understand from your talkings, it's the positive. 2026 is getting more positive for that stage. Are you agree with me? Okay. So, and the last point, actually, as a feedback, we did a growth stage investment. I didn't mention that. There is a Olpak Capital. So it's the first time we did a GP stake. So, and I have a quick question about last question. What do you think about the GP stake in the VC investments? We have lots of VCs over here. They are thinking about the GP stake. As a feedback, we did a different company, which is called Olpak Capital GP stake. And people said, what are you doing? Why do you do GP stake? What does it mean? So what do you think? Very short answer, okay? What do you think about the GP stake? Is it good for the emerging managers to give the anchor LP or strategic people?
It very much depends case by case. If the interests are aligned, if everyone is on board, I don't see any problem with it.
If it comes, look, if a GP stake comes with somebody who's going to seed your future funds, anchor each of the funds, help you become a multi-strategy fund. So, for example, we're now starting to expand products into debt and stuff like that. But we're doing it with our own internal resources. We haven't sold out to somebody who brings it. Then I think it's useful. If it's just a way for people who run the fund to monetize, then it's interesting, but that's a whole different ballgame, right? You should look at it as like what I just said earlier about entrepreneurs taking too much money off the table too early, right?
It's the same thing. Do you want to say something?
For us it's a bit early in the way we're thinking about that, but it could be a shortcut for us to develop in Turkey. And if I may interfere with the management of our roundtable, I'd like to add a sixth point, which is the fact that you have here 3 international investors. So if we're here, it's because we're positive about the outlook of investment in Turkish technology.
Yes.
So I'd like to confirm that.
For sure.
Thank you very much. We have started 1:07. We have a 30 minutes panel. Now it's 1:37. So we finished on time, okay?
Thank you.
Thank you.